You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo. If I sound a little bit different, it's because I'm coming at you not from our studio in sunny, or not quite sunny right now, but usually, hopefully sunny Chicago, but actually far more sunny Florida. We're down here at our traveling studio at the Options Industry Conference 2019. We've got a great slate of guests scheduled for you, so stay tuned to the network over the coming week. A lot of great content heading your way. And next up on our guest docket, we have John Davidson. He is the CEO over there at the Options Clearing Corp. John, welcome back to the Options Insider Radio program.
Mark, thanks very much. It's great to be here, and it's great to be in sunny Miami.
Yeah, it's certainly a far sight better from where I just left, so that's a
likewise.
But let's catch up. It's been pretty much exactly a year since you and I chatted. Of course, the title has changed, so maybe we'll start there. Walk us through what your first few months have been like on the job there as CEO.
Well, it's been a pretty exciting few months. The OCC is the central counterparty for all of the options exchanges in the United States. Our mission is to serve as the foundation for secure markets to protect the financial integrity of those markets and the investors who participate in them. The main thing that we've done this year, and we have a board that represents very faithfully the industry as a whole. Our board has approved a multi-year, more than $100 million investment in totally replacing our technology. That's a 3-year project. Obviously, we're the very early parts of that, but that's going to be very important to our investor community to make sure that we have really the best technology to allow us to continue our function as the utility provider of services, move our costs down pretty significantly once the technology investment is done, and really continue supporting the markets as we have since they were founded now 47 years ago in 1973. The other important thing we've done is we've added some senior management to our options industry group, and we are very proud to be here at the Options Industry Conference, working with our various colleagues in supporting investor education, which of course is fundamental to making sure that people understand these marketplaces, the benefits of utilizing options to maximize the return and the safety of investment portfolios, but also understand the risks that go along with those products.
It's obviously an interesting time. You've been at OCC for a few years now, but obviously it's an interesting time to take the helm as CEO. Obviously, we're coming on the heels of a record year for volume, record in many senses of the word. I wonder, what are your thoughts on that in general? Is it a little bit daunting to come in as CEO right on the heels of such a record volume year? Because obviously it's going to be difficult to try to match those levels, or is it maybe a challenge you're looking forward to?
Well, listen, it's certainly a challenge I'm looking forward to. The OCC itself has no control over volume. We have to make sure that we have a volume-insensitive, highly robust...
I thought you had a leverage on. You could just dial it up to more volume today.
Wouldn't that be nice? No, we take the volume as it comes. We have a volume-insensitive system we have for many years, and of course we'll be replacing it. We did do a record of 5.3 billion contracts, most of those options in the past year. But volume comes and goes. It's been on a general uptrend if you look back historically. I suspect, based on where we are today, we were over 20 million contracts a day in 2018. We're just a skosh over 19 million contracts a day in 2019. So I think we probably won't see the level of record, but it's certainly been on a upward trend over a number of years. And that's what people need to pay attention to, make sure that they are prepared to have deep and liquid markets, and the volume comes and goes as long as the market functions the way it ought to.
So I'll let you know, by the way, we'll cut this out, obviously, but you're tapping the mic stand there. It's audible. I don't want people to think, what is the, in addition to that, I don't want people hearing the thunder. Gene, do me a favor, make a note. We'll tell Kyle to cut that out of the thing there. But, you know, that's an interesting point, because we actually take a lot of surveys of our audience and various audiences, retail, institutional. I was at the STA conference earlier this year, and I did a poll of that audience, a very heavily industry crowd, and it seemed like everyone was extremely gung-ho from a volume perspective. They thought, no way do we not beat 2018 from an overall options volume. I was surprised. I was a little hesitant myself, but I was carried away by the fervor of the crowd, shall we say. So even still, when we poll our audience, they're still optimistic that something will happen to drive those levels again. So it seems like, at least in the industry, and even for a lot of our active retail audience, they still are in the camp that we could maybe make a go at the 2018 levels yet. So you may still have an opportunity to turn that lever up, John.
Absolutely. You know, we've only seen 4 months, and there's 12 in the year, so there's lots of time. There will be a fair amount of volatile events that the options volume will respond to. But again, we are takers, not makers of volume.
Well, you mentioned your technology overhaul. It's obviously a big initiative. That's your Renaissance initiative, obviously a 3-year undertaking, so obviously very extensive, to say the least. You kind of touched on it a little bit. Maybe if you could give our listeners a little bit of an overview of which systems you're really kind of focusing and why you felt it was incumbent to do this extreme overhaul now.
Sure. Well, our current technology, our so-called Encore system, is 20 years old. That's pretty long of tooth for technology in this day of age. It is a very resilient and very volume-insensitive system, but it is not at all flexible. It's based on pretty old technology. We started building it in 1998. It's very tightly integrated, both on the applications and functionality level as well as on the system software level. So what we need to do is break it apart into its constituent components and gain more flexibility, as well as updating the environment in which it operates very substantially. So we'll divide it into 3 components. The first being the core processing component that takes match trades in from the 16 exchanges where options are traded here in the U.S., as well as 3 futures exchanges, and takes the input from clearing members, processes that information, and produces reports back to clearing members and exchanges. The second and very important function that is too closely integrated today and needs to be separated, and we've made some good progress in that regard, are the risk management functions. So we will update the risk management functionality as a separate project. And then finally, the data that underlies all of those, that reflects each day's prices, each day's positions, each day's activity. Currently, it is very hard to access for us, or for that matter, for our market users, and we'll be providing much more functionality in that regard. We have a good partnership on the first part of that, the core processing, with a Swedish firm named Cinnober, which is now part of NASDAQ, and they are working with us to develop the new system. We actually received delivery of the computer code and installed it in our system in the AWS cloud last week. We have a successfully functioning, but not yet meeting all of the requirements, clearing system, which we are in the process of testing and continuing through a series of 19 different so-called sprints to upgrade that to the requirements that the industry expects. We are continuing to assess the best way forward with the risk technology. We've made a lot of progress with our ability to get better functionality managing intraday risk as opposed to just end of our overnight batch processing cycle. And the work on the data structure is very well underway.
Maybe your tech people can find a way to turn off that air conditioning so we don't have those repeated noises coming in throughout our conversation here, John.
It's something that we have a few challenges with. We don't do HVAC tech very well, I'm sorry to say.
I'm sorry to hear that. But you mentioned it sounds like the initiative is on track, which I'm glad to hear because I know a lot of our listeners will be interested in that. Speaking of things you're interested, you kind of touched on it there. I want to dig into it a little bit more. Obviously, the risk side is an area where we've seen a lot of questions about of late. Obviously, last year with the volatility spike, there were some questions around how much risk modeling was done there. We also just had the folks from Box in here a little while ago, and they were mentioning that they're having a hard time getting some of their volatility products on the modeling side. So, is there a time frame for when you could think you'll have the risk modeling element of Renaissance complete?
So we're making a number of enhancements to our risk modeling. We did a number of those in our legacy Encore system. So one of the most important things that we did over the course of the last year is to completely change the way we model stress testing to determine the size of our clearing fund. So as a result of a fairly crude set of estimations, our clearing fund last year got up to be $18 billion at a period of time when volatility was relatively flat and volume was relatively unchanged. That was completely modified and replaced with a 110 scenario stress test based system in September of 2018, which allowed us not only to move from a cover 1 to a cover 2 level of financial integrity, that is to say we have the resources required to sustain the simultaneous default of our 2 largest clearing members, but it also allowed us at the same time to return $3 billion to clearing members to reduce the capital requirements of participating in this business. The risk models, we have made a number of enhancements to, and we'll continue to make those enhancements. There was an issue with the so-called GARCH parameter in that volatility issue in February 5th, actually, of 2018. The implied volatility spiked very dramatically, and the GARCH parameter suggested that it would continue to spike at that same level. There were a number of issues, both with some pricing in the market late in the day, as well as with the behavior of that particular model. We have since replaced that model, and I think we're in a much better position. We have a number of continuing enhancements to our model environment, the method by which we smooth prices and make sure that over the 970-some thousand options that we're responsible for clearing, that we have put call parity assured in all of the relevant cases. We have some additions to our so-called Model Zero, the fundamental options pricing model, particularly for European options, and a number of enhancements continuing in our clearing fund. So the next ones that will go in will address wrong way risk with respect to positions that a clearing member holds of securities that it has been the issuer of, as well as idiosyncratic risks. The current model looks most carefully at large moves in the biggest indices, but you could have a situation where a few tightly concentrated stocks could cause an issue. So we're doing some more stress testing around that and seeking SEC approval for those model changes. The last of the major enhancements to the clearing fund will be stress testing our liquidity levels. So we have a lot of liquidity as an institution. That's something we also enhanced in 2018. About $6 billion between the $3 billion cash in the clearing fund that we keep on deposit at the Federal Reserve Bank in Chicago, a committed bank syndicated lending facility for $2 billion, as well as a committed facility from CalPERS, the pension fund, which provides us the incremental $3 billion. but we don't have a robust, approved by our regulator process for stress testing those liquidity needs and taking various extreme but probable changes to the availability of different forms of credit, and we will be putting those changes in place later this year. So I think we'll be in a much better place as we get into the last quarter of the year with respect to the ability to more timely support the new product innovations that our exchanges bring to us.
Speaking of regulatory approval, one of your ongoing initiatives on that front has, of course, been the capital plan. It's been, shall we say, an interesting issue to watch unfold over the past few years. Some people in the industry are for it; others have been outspoken against it. We've seen the SEC seeming like they were coming down in favor of it until recently, when they pretty much came down on the other sides of them. I'm curious now. What are your thoughts on that whole process, how it played out, and where do you stand? Where do you go now from here?
Well, look, we're in a much different situation than we were in 2014 when we began this journey. So in 2014, there was only $25 million in capital at OCC, so enough to support maybe 6 weeks of operating expenses. That's an absurd level to try to run a market structure utility on. We're in a much better situation at this point in time, based on things that have transpired since the 2014 beginning process. Notwithstanding the disapproval, we have over almost $290 million worth of capital. Our board took very prompt action once the SEC made their disapproval decision. Obviously, it was quite disappointing to us, but we quickly established with the board, reestablished a decision they'd made at the end of 2018, that the level of capital we need to sustain the operation for a 12-month period and support our resolution and wind-down plan was $247 million. So we were, notwithstanding the fact that we returned $110 million of the $150 million that the 5 exchange owners had invested in us, we returned that to them. We will return the remainder of that in all probability before the end of the year. We did increase our clearing fees by a very modest 10%, half a penny, to make sure that we were able, notwithstanding the somewhat downturn in volume that we've experienced so far this year, continue to build the appropriate level of reserves. We have gone to our board, but are still continuing the governance process and obviously have regulatory approval yet ahead of us to describe the manner in which we will manage our fee environment. We want to make the fees much more close to a level that is break even, as opposed to the practice that we've had in place since 1998. OCC has collected $2.2 billion more in fees than it needed and refunded those back to clearing members. That's a very strange way to run a railroad, if you will, very capital inefficient, and so we think having a more appropriate level of fees constantly, as opposed to building these huge amounts up and then refunding them at the end of the year, is a better way to run it once we've made the capital investments in our technology and infrastructure. We do not have any dividends at all in the new capital management policy, obviously subject to regulatory and other approval, so that while the fees do eventually build up retained earnings, which accrue to the benefit of the 5 shareholder exchanges, there isn't any way that they can realize on that investment. There's no dividend cash flow to them. And so on this basis, the one piece of the puzzle that we have yet to put in place, in the very unlikely event that some sort of an operational or a business risk draws down our level of capital. And the most important thing, I think, to keep in mind about the capital plan is it had nothing to do with the financial integrity of the markets. So the margin levels, the deposits by clearing members, the clearing fund, those are all separate. The capital plan and the capital that we hold over $290 million at this point in time are for the protection of the institution against a large operational risk or a large business risk, a very pronounced downturn in volume for an extended period of time. So we need to have a replenishment plan. We're working on a number of alternatives with our board, with our shareholder exchanges, and all of that will eventually be subjected to the regulatory oversight process, including public comment on the details of that. We'll be having a conversation with the SIFMA Options Committee a little later today, going through some of those ideas and get some industry feedback on that. But I think we're in a, notwithstanding the disappointing news of the disapproval by the SEC, we're in a much better position as an industry and as an industry utility than we were in 2014. And we'll continue to find a way forward to both have a sufficient and replenishable level of capital to support the operational risk management of the institution, continue to make these investments in our technology, and then on a going forward basis, re-engineer the entire organization so that we are both more effective and more efficient.
Did they give you any insight into that this was coming? Because it seemed like they were on board with the plan right up until they pretty much weren't. Was this a surprise to you as it was other people, or did you have some feelers that this was coming down the pipe?
The regulatory process is always pretty uncertain, and as soon as the Circuit Court of Appeals in Washington, D.C. Remanded it, there was always the possibility that it could go one way or the other. And so we were thinking about potential means of addressing that throughout. Obviously, I think both the OCC as well as its shareholders would have preferred to continue with the capital plan. That's not to be, so we're moving to the next stage.
You mentioned your educational initiatives. Obviously, the OIC, the Options Industry Council, we're big fans of it. We produce a lot of their programming here.
Absolutely.
On the net. We just launched a new one recently, Towards Advisors with Eric Cott, so that's a fun new one. Check it out, listeners, if you haven't already, Coffee with Cott. I'm curious, what are some of the big initiatives for you with the OIC going forward?
Well, I think obviously we're in a period of time where the users of our markets are going through a generational change. And I think things like the Options Insider and the media through which you attract market participants are really important. And so we need to continue to support that trend, to not think just about in-person seminars in various hotel conference rooms, but use the various forms of social media in order to reach those investors. And those investors run a wide gamut. So there are new participants in the markets. Obviously, we need to get more participation in options markets by the millennials. They are going to be moving quickly into the wealth accumulation phase of their lives, and options risk management tools are very important in that phase of one's life. But we also have very sophisticated users and a number of institutional users, and just finding more ways to work with our clearing members in particular, to work with different social media channels, to think about how to deliver this objective, unbiased options education to a wider span of users. We did get to 84,000 discrete users in 2018. That's a good accomplishment. I'd like to, we don't have any control over volume, but we do have some control over, our access to market participants. I'd like to see us beat the 100,000 investor target in 2019.
I think with Coffee with Cott, you may be well on the way. Well, there's been an interesting, maybe somewhat alarming trend I've noticed since I first got into the industry. When I first came to the industry in the 90s, of course, there were different exchanges, and pretty much every exchange entity had an educational arm. They saw it as part of their mission as an exchange to help educate the trading public, professionals, and all of the above. And because these products, they can be intimidating to a wide variety of people. As the years have gone on, we've seen most of those exchanges migrate to public for-profit entities, and one by one, the education arms seem to have gone away. A lot of them seem to have abdicated that responsibility to OIC, and you guys do a great job, but it's a lot of responsibility that they're putting on your shoulders. Outside of CBOE, I can't think of another exchange that has an educational entity. Would you like to see maybe the industry start to go back to that trend where a lot of the other big players in the space, the exchanges and others, maybe start to take up the mantle alongside OIC and start helping to get the word out there about options again?
Well, the exchanges are all participants in OIC, and they support us, and obviously the work that CBOE and others do is very important. Exchanges clearly have a focus on their new products. That's their main means of increasing revenue over time. We like to make sure that at OIC we have a product-neutral approach to this kind of education, and I think the most important way of increasing participation is working with the broker-dealer clearing members that are active in the market and making sure that we're leveraging their education of their investors. They obviously have an interest in making sure that investors are well informed, and so we'll be spending more focus on those kind of channels. Educational institutions, we had a great program earlier this year, if I'm not mistaken, with the University of Chicago and Barron's, and major business schools are taking a more serious interest in options education. Quinnipiac, the school, has a huge program for undergraduate education that we are big participants in. So there are a number of different channels. Obviously, the exchanges need to make their own decisions about the best way of supporting investor education, but they've been quite supportive of OIC.
So you think the onus has shifted now from the exchanges onto the broker-dealers? They're kind of the front end, the bleeding edge of the educational initiative, if you will?
I think that's a good piece, but obviously OIC does provide that objective and neutral perspective on investor education, which I think will continue to be very important.
Whenever we prepare for the Options Industry Conference, we always give our audience a chance to weigh in and tell us what's on their mind, what they'd like us to ask. And when we started talking about clearing, they had a couple of interesting questions that I think that come up a lot, and particularly this time of year, we're in earnings season now, so we see a couple of these very frequently. The first one that our audience wants to know is an interesting one, because we've, as you mentioned, we've kind of graduated this next level of retail traders out there now. They've grown up in a marketplace where executions take place in milliseconds, and they're used to this environment, and yet they still have an environment where open interest updates once a day. So they see a little bit of a disconnect between the two. And they reach out to us all the time, so I'm going to put it on you, John. Why is that? Why can't we have these trades going up faster, and maybe not instantaneous? They want instantaneous. Let's take baby steps. Maybe even just an intraday update for open interest, something along those lines. Has there been any inquiries into that? Any progress on something like that, or is that not even on the radar at OCC right now?
Well, certainly being more aware of net positions on a intraday basis is very fundamental to our enhancement of our risk management functionality. Actually having a recalculation of open interest in sort of a multi-times a day or even on demand is very challenging, in part because of the way that market makers and other participants trade. They need to net their positions out at the end of the day. They may be making a market in a particular series and need to offset that with a trade that happens a bit later in a different series, which sends them home risk flat, but with an inventory of positions. And our stance with respect to open interest is, once we calculate open interest, we margin all the open positions on the basis of that calculation. So doing intraday original margin for what we call top day trades remains a challenge. There are open close indicators as part of the transaction record in the options industry, not so much in the futures industry, but those are not necessarily consistently utilized by all of the market participants. So It's an interesting challenge. I understand the desire to have better information about open interest. I think you could probably talk about focusing on maybe a subset of the more active names. But we haven't done a lot of work in that regard, but it's an interesting challenge.
So it's not a part of the Renaissance Initiative yet?
Well, the Renaissance Initiative will give us much better tools to enable the ability to do that. So I will take that back and see if people have some thoughts. But it is definitely a challenge.
Yeah, we get that question conservatively 5 times a week, conservatively. So I'm going to start forwarding them to you, John, and then
That's fine. That's what we're here for.
Let you answer them. The other question we receive a lot, usually more often this time of year, which is earnings season, is this. People are out there, they're trading their stocks, Microsoft, Google, Amazon, whatever it might be. They see that it goes into the after hours, and they could close it out, maybe open it in the after hours. They can't do the same with their Google or their Amazon or Microsoft options. So inevitably, they email us. So I'm going to ask you, John. This is an interesting question. I usually take the pulse of this industry, this conference every year about this topic, and a lot of people point to OCC, and they say maybe OCC is an interesting place to discuss that. So what are your thoughts in general on the prospect of opening up options to after-hours trading? Is that something you think is reasonable in the near future, or is that kind of a bridge too far? Where do you think we stand on that?
Look, I started my work in this industry in 1980 in the futures business, and the futures business since then has come a much, much further way than the options industry has with respect to extended hours trading. The CBOE does have some extended hours on a couple of its index products, but the single name options are not accessible after the close of markets 3:15 in Chicago. I think we need to change that. I think there is a demand for that. Obviously, in the first instance, that is an exchange decision, not an OCC decision. But the OCC has, because of our legacy our legacy technology and the fact that we don't yet, but we will soon, have much better tools for intraday, which could also mean overnight intersession risk management. We have a requirement that if you're going to participate in even the limited after-hours trading, you have to put up an extra $10 million in margin deposit. Now, don't ask me why $10 million is the magic number and why that number ought to be the same for every single clearing firm that participates, and regardless of the size of their portfolio, but that's what the current rule is. We need, once we have these tools in place and tested a little bit, to go back to the commission and see if we can take that out. And we need to be able to demonstrate that we have the ability to manage the risk of these positions overnight. Since the markets opened and the futures market started doing much more active trading, the intra-bank system for moving money around has much more extended hours, so the risks of being able to actually move money at crazy hours of the night have gone away. You can do that not only in US dollars but in a number of other currencies. So I do think that OCC needs to make sure that it's got the capabilities to manage those risks, change this rule, which probably doesn't deter large market clearing firms, but may deter some of the smaller institutions, to something that is a lot more risk-based as opposed to arbitrary and easy to put in place, and really see if there is appetite by one or more exchanges to do that. Obviously, that would require regulatory approval, but I think the track record in the futures industry is very, very strong. There isn't any more volatility after hours than there is during hours. Yeah, there are going to be a few issues around, if a stock closes, news pending, when do you reopen it in the after hours? The industry can work through all of those issues, and I think once we've built the infrastructure, which will be actually not too many months from now, the industry ought to work together on changing that. Maybe it's not going to be as successful as been in the futures, but it can be a whole lot more successful than it's been so far.
Interesting. I like hearing that. You're more optimistic than a lot of the other participants we've had at this conference in the past, John. So that perhaps is a note of hope for all of the listeners out there who've been pestering us about that question for years. Well, John, we've had a very far-reaching conversation. We talked education, we talked technology overhauls, we talked capital plans, we talked risk modeling, we talked after hours, talked real-time open interest. I'm not sure if we forgot anything, but if we did, John, maybe you want to leave our audience with a little bit of a hint, a little bit of a tease of what they can expect coming down the pike from OCC in the coming months. Now is the time, sir. The floor is yours.
Well, we've got to be in full execution mode. The board is holding me responsible for delivering these technology upgrades, but fundamentally for re-engineering OCC. That's why we call it the Renaissance Project. It's not just about technology. It's about changing our entire processing environment so that we can have dependable, reliable, low costs to our clearing members and exchange participants, and make sure we continue to be the foundation for secure markets, being one of the best capitalized, best run central counterparties in the entire world.
Well, John, thank you for coming on. I'll look forward to seeing how these initiatives play out in the marketplace in the coming months.
Thank you very much.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.